set the stage here a little bit now while I talk to you about the first panel session that we're going to have this morning, the consequences of growing risk. So we're starting with a big question. In a world of growing uncertainty, are the ways that the sector understands, models, insures risk still fit for purpose? As we've heard, risks today don't happen in isolation. Geopolitical tensions, climate events, cyber threats, supply chain disruptions, they're increasingly interconnected, they can amplify each other. That impacts how risk is assessed, priced, managed. It has implications for underwriting, capital allocation, and the wider question of what remains insurable and at what cost. This session is going to bring together perspectives from across reinsurance, specialty insurance, and brokerage to unpack what this means in practice and how the industry is adapting. So now that we have our chairs, let me welcome our panelists up onto the stage. I'm going to be joined by Stephen Hardy, Director and Head of Life and Health Ireland and Canada at Hannover Re, bringing the life and health reinsurance perspective. Patrick Davison, Director of Class Underwriting Performance and Solutions at Lloyd's, at the heart of the global specialty insurance market. Eddy Vanbeneden, Head of Advisory Europe at Guy Carpenter, with deep expertise in risk modeling and catastrophe analytics, and John Huff, President and CEO of the Association of Bermuda Insurers and Reinsurers, representing what is often described as a global shock absorber for risk. Please join me on stage. Grab this one. Wonderful. Okay, well, thank you all so much for being here with me this morning. I'm going to start with Eddy, actually, to kick off. So when we're thinking about the risks today, we've just talked about the interconnections. We're looking at war, energy, climate, supply chains, inflation, things like monetary policy. There's an obvious example, the war in Ukraine, with all of the energy and financial markets impacts that that's had. For you, what's the biggest change in how you see risks interacting nowadays, and is it something really new?
Yeah, thank you, Kathryn, and first of all, thank you for having me here today. Very pleased to be with the other panelists today. I would say that the interconnection between risk always exists. We take only a few examples. We had the World Trade Centers, which was impacting not only the insurance sector, it was drying up the terror market, creating the new pools. We discussed that a bit later. And it was also having some huge impact on the financial market. We are talking a lot about supply chain today. In 2011, we had a very large flooding event in Thailand, which was already impacting the hard disk supply chain and also the automobile supply chain. And recently we had the COVID-19 with all the impact and also the post-pandemic inflation. So we were always facing this challenge of interconnectedness of the risk. What is changing today is probably the depth of the interconnectedness. We see because of the globalization, because of the change that we are facing, because of new technology, we see more and more depth in the interconnectedness. And what we see also is the volatility associated to it. It's changing very quickly. The risk is changing, it's adjusting to the new reality. And that's certainly one of the important changes that we are observing and where we have to adjust. I would say that the industry is adjusting to that. We see more and more stress tests that are organized by the industry. And we see also insurance companies, but also more globally in the risk management sector, we see that the companies and the industries are organizing more and more what-if scenarios with their foresight team. And it's not to try to only forecast the future, because as it was said before, it's very difficult to forecast the future, but it's also to train the teams to react to the new shocks, to not be surprised, to not only live on the past and the present, but say that new shocks will arrive, they are more and more frequent, and they are training the teams to be more ready to react when such a shock is happening. So it's probably the speed and the volatility, which is the two most important impacts of what we are experiencing today.
Okay, thanks so much. Patrick, I'm going to come to you now. Loath as I am to quote one of my competing media outlets, there is a pertinent quote from Martin Wolf at the Financial Times. He said, "First came the war, then came the blockade, now come the shortages." So when tensions rise and they stick around, like in the Gulf as we're seeing now or elsewhere, what do you see in terms of insurance capacity? Is it stepping back? Is it adapting? Are we still able to insure all of these risks? Are conditions changing? How do you see that picture?
Well, first of all, good morning, everyone. Thank you for the invitation to speak here. I mean, I won't comment on the quote, but it's a great question. I think when we think about what we see here in global geopolitical, macroeconomic uncertainty, we do feel that this makes it a harder environment for risk takers to operate, but it's also incredibly important that they do operate in this environment. I think if the insurance industry steps back when people seek to transfer risk, we've failed. So we've seen lots of great examples through Russia-Ukraine, through the Iran conflict of particularly Lloyd syndicates, but this happens elsewhere, of people creating solutions actually to try and unblock some of these major problems. So you talked about supply chain there. There's a facility being created in Lloyd's that supports the movement of goods by lorry from ports that have been under attack. We've seen similar facilities set up for shipment of grain out of Ukraine. Equally, war risk cover in Ukraine. It took a little while to get that going, but I think that symbolizes quite neatly the insurance industry's desire and capability to step forward when they're needed. I would say this, of course, but I think Lloyd's, as a marketplace of multiple entities with multiple diverse balance sheets, the ability to bring capital in from lots of different places, is an ideal market to do that in, because this risk that is uncertain, is volatile, can be shared across multiple partners rather than over-relying on one. I think when we think about how we do this, we really need to be able to analyze and understand the changes in frequency and severity that we're observing. And really, I think the biggest challenge that we face as an industry is understanding with confidence whether previous assumptions around geopolitical norms might be changing. And that affects multiple different lines of business. Are we seeing a genuine change in the risk environment that leads to more state-sponsored cyber attacks, more regular, broader, kinetic conflicts, encompassing regions, drawing in allies? These are not risks that we do not understand, but they are risks that need very, very careful consideration. Finally, I just comment on the sort of macroeconomic element of this. The potential for inflation, recession, these play through to the insurance industry as well. We maintain a very, very close eye. Eddy mentioned COVID, clearly inflation post-COVID, Russia-Ukraine on top of that. If you do not keep an eye on claims costs, you lose money very, very quickly. And that is a key feature for us. Equally, if we move into a recessionary environment, growth ambitions are become challenging. These are all things that insurance companies have to constantly be managing. And it's something that we as Lloyd's, the corporation, have to manage as well on top of what the syndicates operating in our market do.
And in this very complex, very global picture where you're thinking about all of these risks at the same time, I mean, if I were to ask you what you're most concerned about?
I think it's misunderstanding whether the underlying assumptions are correct. I think that's a problem. I think we feel very strongly that whilst the conflict in the Middle East is very dynamic, has elements that are surprising, our marketplace, and I think lots of marketplaces have responded as we would expect. We are the home of war insurance globally. echoing my point earlier, if the war insurance market does not provide insurance when there's a war on, it's failed. So the ability of our market to continue insuring vessels in the Persian Gulf, to continue quoting for transits through the Strait of Hormuz, almost throughout this conflict, has been incredibly positive. So I don't think this conflict has changed anything per se, but that potential to misunderstand what this means going forward, so for the next 2, 3, 5, 10, 15 years, is incredibly important that the insurance industry gets that right.
So plenty to keep us busy.
Absolutely.
Stephen, we have another quote here, or at least a paraphrase, from a UK politician, UK Foreign Secretary Yvette Cooper, who recently warned that the war in Iran and the blockade of the Strait of Hormuz could trigger a global food crisis. From your life, health, reinsurance perspective, how do you interpret that kind of shock?
I'll take that. Hi, Kathryn. Thanks for the question. And
I'm just speaking to the room. Sorry.
It's lovely to be here this morning. So I'll probably just start, like, where does the food crisis come from? I guess it's very obvious with the war in Iran, there's an energy shock, and we see that. I guess kind of less obvious, the manufacture of fertilizers is highly dependent on natural gas, and so I think something like a third of all the fertilizer is exported from the Middle East. So it's that then causes onto the food crisis. So I'll come back to the insurance aspects of that. I think where the biggest risk I see is then, as touched on, the move into the economic impacts, the inflationary impacts from the food crisis and the general economic scenarios. I think at the moment markets remain very buoyant. Inflation is moderated from post-COVID. Interest rates are at kind of more normalized level, but I think John Schindler from the FSB set out very well at the start of the conference today. It feels like the ingredients are there for a potential financial crisis. So I think things are building. We've had crisis on top of crisis. So I think in the life and health space, that would be where I'm more concerned, that financial crisis. And where that leads into is really that policyholder behavior. So we see, policyholders are under pressure, like for their own, financials. We do see kind of the lapse behavior, and we're the life and health is mostly savings and retirement planning. So that becomes under pressure, and so it's that impact on the lapse of business, and then lapses in general always have an anti-selective nature to them. So that feeds back into if people have to choose what they're going to spend their money on, if they're lapsing policies, it's usually anti-selective in nature. So that feeds back into the experience on protection policies, etc. So in times of recession and crisis, all of those policyholder dynamics is what we're worried about. Kind of moving beyond that, I guess kind of governments are increasingly, we see, expected to kind of step in and shield the public from these outcomes, and we would be concerned again about the long-term debt dynamics and the sovereign debt crisis we see. So I think there's almost an expectation that governments will support the public in these, and as an insurer, we have as a life and health, we have very long dated liabilities, very long, match that a lot with investments in government debt. So again, kind of, it's nearly 20 years on from the financial crisis, but government's balance sheets are not in a healthy position, and another crisis on top of that. So we are long-term investors, and you want to see those sovereign debt dynamics in a healthy position, that it doesn't lead to another crisis. And ultimately, coming back to life and health, if governments don't have money to fund health services, there's also knock-on effects there that we need to think about for the long-term trends for mortality, morbidity, etc. So it's kind of from the very short-term food crisis, that probably in itself is not a big insurance event, but it's the economic and the very long-term impacts where we do see that it will have impacts on the life and health business.
So it's this overlapping of everything.
Yeah, it's everything coming together, and it's definitely those medium to longer-term aspects that we'd be more concerned about.
Okay, thanks so much. Last but not least, Bermuda. John, Bermuda, it's often called, so I'm told, the global shock absorber for risk. When global shocks start converging, what does it mean for you in terms of being the shock absorber? What does that mean in practice? Where do you think additional global capacity will be most needed over the next few years?
Well, thank you very much, Kathryn. Let me thank Insurance Europe and Taya and Frederick for the invitation to be here. It's my pleasure. I split my time between Washington, D.C. and Bermuda, so I'm there about a third of my time. If you're not familiar with the Bermuda market, we cover about a third of the global P&C reinsurance risk. And that comes up periodically. The most recent would be the California wildfires, where Bermuda took about 30% of the insured losses there. We're becoming increasingly known as leaders in the specialty markets as well, and whether that interprets to be in cyber, terrorism, mortgage risk, there's quite a bit of expertise. We say per square mile, we have the most insurance, reinsurance talent in the world. Now we have 20 square miles, so you go from there. So we have been talking, particularly the last 6 weeks, a great deal about the topic of this conference. I've been calling it #resilience, #reinsurance. And over the last 6 weeks, we had several hundred international supervisors on island last month, and some joint conferences talking about the future of risk and the future of resilience. And some of you were on island there during that period of time where we had those conferences. And then most recently, 3 weeks ago, we were honored for the first time in 400 years to have a royal visit and have the king stop in Bermuda, his first overseas territory trip on his way back to the UK. So we've been talking about reinsurance and resilience, particularly in how it relates to global leaders and their policy objectives. You talk about Bermuda being the shock absorber. We've always been known to be the low frequency, high severity risk absorbers, if you will, a great deal of capital and capacity on island. If you think just in the most recent history, 20 years ago after Katrina, Wilma, Rita, immediately you saw companies pop up with new capital to face the new risk after those events. Right now, we even have one of our largest companies, Arch Capital, celebrating their 25th year. It's amazing that it's been 25 years since September 11th. But after that, was tremendous loss in the U.S. Of course, there was a capital came to Bermuda to set up new vehicles to absorb the loss. If I had to talk about two ways things are changing really, and it relates to adaptability and diversification. I think you no longer see monolines, whether they be in property cat cover or even in mortgage insurance. You really see balanced and diversified portfolios with non-correlated risk. That's what makes this entire system work, and it's very important. And Bermuda has always been punched above its weight in terms of controlling aggregation of risk. It's so important, and it's of course it's easy to visualize that California wildfires might not be related to Florida hurricane risk, but as we get into more complicated areas on aggregation like cyber and some of the other risk, AI, it certainly will be an area to keep an eye on. If we talk about where capital and capacity may be deployed, what's going to be important in the next 2 to 3 years, which I think is the second part of your question, I would leave us with just two words, simplify and mutualize. So how can we simplify this protection to make sure it's going to places where there are uninsured? We think of uninsured many times, we talk about developing markets. I'm a former U.S. insurance commissioner. You see uninsured right in the most developed markets and the largest insurance markets in the world. Another anniversary that we're celebrating, or marking, I should say, this week was 15 years since the Joplin tornadoes in my home state of Missouri. So the largest insurance event in Missouri history. And if I can say, the saddest part of being the insurance commissioner doing that terrible event that hit our state were the people that did not have enough insurance coverage. When you have a total loss of a home, but you didn't have enough adequate coverage, you may be fully reimbursed for the value of your policy, but you are not protected to continue your life as you want it to be. That's where we have a challenge. So when I talk about protection gap, I mean both developed and emerging markets.
So you're well across both your hacks and your hurricanes. Okay, Patrick, I'm going to come back to you. So we've seen recent reporting about disruptions at major choke points that can spill over from things like energy to fertilizers, food systems. We're seeing the effects of it, price increases, knock-on volatility across financial markets. When you see a single disruption cascading like that across the system, what does that mean in terms of insurability? Are we still thinking about risks line by line? Do we need a more joined-up approach? How do you see that?
It's a great question. First of all, I'm going to resist the urge to pick John up on the how much expertise per square foot.
Please do.
EC3 is 1 square mile, so we will talk numbers later. No, I think we do increasingly, and actually John made the point about diversity, we do increasingly need to think about cross-class accumulations. So if I think about the Iran conflict and certainly the sort of early days where there was a huge amount of uncertainty as to where that was going. As Lloyd's and the syndicates operating in Lloyd's, clearly everyone was very fast out of the gate understanding where exposure was as a starting point, and then thinking about potential losses that might actually transpire, because exposure does not always relate directly to loss. So, we were thinking about 6, 7 lines of business that we tend to think about independently, but this event clearly showed. So, marine war, aviation war, political violence and terrorism, cyber, I think is a very good point, political risk and credit, energy. These are all lines of business that Lloyd's writes in its £65 billion diversified portfolio. That generally get thought about individually, but needed to be thought about together. I think the interesting aspect of it, as we've seen the event evolve, is how the conflict has actually impacted those lines of business is quite different, both in terms of quantum, but also in terms of time. And I'm just going to put a huge caveat here. Clearly, the event has space to evolve, so this is a 28th of May comment. In marine war and political violence and terrorism, we have seen losses. There have been vessels damaged, there have been energy infrastructure damaged, hotels, some residential buildings. But clearly, the primary target early on was energy infrastructure on both sides. So that, in and of itself, challenges a diversified portfolio. If you had decided, for the sake of argument, to only insure onshore energy assets in the Middle East, you have got a very, very different loss profile to one of your competitors who might have written across all of those lines of business. So it's a very complex calculation that needs to be undertaken. I think just generically, if I think about all those lines of business, the way that we think about managing those and how you price for uncertainty requires incredibly sophisticated capability these days. So traditionally, 20, 30, 40, 50 years ago, people would look at volatile risk and be very attracted by it because of the returns and not necessarily think about the downsides. And you can go for long periods of time, both in natural catastrophe and particularly non-natural catastrophe losses, where very little is happening, and you can convince yourself that your portfolio is incredibly profitable and lose sight of the fact that when the event does happen, that is the volatility that you're there for, and if you walk away at that point, you have failed. So we, as Lloyd's, we oversee these lines of business. We think of them as volatile classes. We do not oversee them on a pure, 1, 2, 5, 10-year profitability metric. It is very much about capability, and that includes in accumulation management, pricing, understanding what diversity in the portfolio really means. And I think very pleasingly, the speed of improvement in sophistication over the last decade and even over the last few years has been pronounced, which I think is incredibly important for us, because we still need to be able to lean into these areas of risk.
Okay, thanks so much. Stephen. Let me ask you about risk drivers for life and health reinsurance. So we see that life and health models, they're built on demographic, biometric assumptions, mortality tables, morbidity trends, and longevity curves. Are there specific challenges which need adaptations of your risk modeling, your risk management, your underlying approaches? Where are we seeing the biggest risk drivers there?
Okay, thanks, Kathryn. So I'd say kind of the risk drivers for mortality and morbidity are ever changing. So I think we've had dramatic increases in life expectancy over the last 100 years. Interesting, life expectancy, not lifespan. So I think the oldest person ever to live died 30 years ago, and there isn't a big queue of people to overtake her. So we haven't yet cracked the lifespan issue, but we have done a really good job in preventing kind of early deaths and kind of the causes, and so life expectancy has dramatically improved. But the reasons for that have changed over time. So cessation of smoking, significant reduction in accidental deaths in the 90s and 2000s. Cardiovascular was a huge driver of improvements there. But then we saw a real slowdown in the 2010s in overall kind of globally mortality improvements. And a lot of that was down to like lifestyle, essentially kind of like diets, more inactive, poor sleep. There was a clear kind of slowdown in mortality improvements in the 2010s. So that was a really interesting kind of there. And then on top of that, we had COVID. But what we do see now is there's definitely a much more, people are more aware of kind of how lifestyle plays a part in their health and well-being and their mortality. So we do, in terms of risk drivers, it's ever changing, and I think we're moving back into a phase now where we do see kind of people kind of appreciating what makes a healthy lifestyle, what are those causes. One of the real big hot topics at the moment is the weight loss drugs, the GLP-1s, and what that will do for the mortality and morbidity markets. So it's early days to say what the long term, but it does feel like I think there's a better appreciation of these, and I think they do. People want to be healthy. People know what the right things are to do. But it's just sometimes hard to live. I think the GLP-1s, they'll help people to live kind of how they want to live. So I think there will be mortality improvements in the future, and there is huge investment. People are very, there's lots of money spent on kind of improving life expectancy. So I do kind of see, but over time, those long-term trends that we have to deal with in life and health are increasingly uncertain, and it is hard to predict those. That's kind of the risk drivers are changing. From a risk modeling point of view, sometimes it's the fundamentals. So there's lots of new tools, things that we have AI, tools are better, it's quicker. The fundamental is kind of the same. You need good data to begin with. So I think it starts at good data management. You need to kind of be able to get the data in, organize it, be able to kind of interpret what you see. And then, as an actuary myself, the classic actuarial control cycle. So you have a problem, you design a solution, and then the big part is you monitor the experience and feed it back into what you're doing. So having good data. So all these new tools in the risk modeling are great, but it starts fundamentally at collecting the data properly, having good processes, having good structures there that you can be able to analyze it and then feed it back into your long-term assumptions and long-term trends. Moving on to then, on the risk management side, I guess as a reinsurer, there's huge benefits in global diversification and diversification across lines of business. So if it's mortality business or morbidity business or longevity business, huge benefits on the risk management side and having that diversification. Where we see, and also having kind of appropriate risk appetite and risk limits in place. I guess coming out of the pandemic, a clear trend we've seen is we do see a demand from insurers for that extreme mortality cover. That is a line of business that we write, but we don't love, because at the end of the day, that isn't a line that diversifies well. So, we like business where, as a global reinsurer, you can diversify, across different lines of business. So again, it's having those, in terms of risk management, having appropriate risk appetite and risk limits in place.
I didn't expect that we'd be talking about Ozempic before we even got to the coffee break today, but I'm glad that you're spicing up this morning's discussion. John, let me come back to you now. So I want to ask you about the transfer of risk between markets. So some risks, when we're thinking about war, extreme events, they can become too big for just private reinsurers. Do you see that there's a trend of transferring risk to capital markets? Do we need to go beyond this and look at public-private partnerships? How do you see this one?
Yeah, and I really view your question, Kathryn, as two parts. One is the vehicle for how we transfer risk or managing risk, and then bringing in the public-private partnerships, perhaps. So the first question related to the vehicle, it's very interesting because our markets are getting so sophisticated that we're really looking at diversification in terms of distribution and ability to where you want to operate and where you want to put capital. So I use the example with Lloyd's. Almost all of our members of ABIR have a Lloyd's syndicate, so they choose to use the Lloyd's distribution when it's appropriate and it's most efficient for them. They also, of course, have their own balance sheet and their own companies where they can write some of those risks directly. And then they may decide, I have a saying, it's a little bit of a Bermuda commercial, all roads lead to Bermuda, because if you think about your options of how you may parse out risk, particularly now as you've seen attachment points rising in insurance towers, you see a real need for robust captive management for some of these underlying organizations. I just came from the RIMS conference in Philadelphia with 11,000 people, risk managers that are on the ground looking for how to manage their risk. And so the captive area, we don't represent captives in our trade group, but they're really important now, particularly as those attachment points go up and down. And what we've really found also in the Bermuda market is nearly all of our companies have their solid, well-capitalized balance sheets, but they also have in parallel, they're running an ILS or a partner capital vehicle where third-party capital can come work in tandem with their risk. Why does that work so well? Well, it really works because the third-party capital, they want to make sure the people that are running those risks, managing those risks, know the risk business. So they're comfortable, the flight to quality to our member companies, and as that third-party capital comes in, it's really a double dip for them. They're getting the strong balance sheets of those ABIR member companies, but they're also getting the third-party capital. So the vehicle is one thing. Now, I'll go very quickly to the public-private partnerships because there's so much good material that's been written on this. If you have not read the Insurance Development Forum on insurability, that's one takeaway for you today because it's the job of all of us to work on how do we make more risk insurable, because all the data and all the research tells us that's how you close the protection gap, and that's how communities recover after extreme events. So insurability is so key. The beauty of this report, it is so practical. There are 50 action items that tell us how to get engaged here. And then finally, I would close with, there is a need, if you think in so many areas, that to have a public-private partnership where government steps in to take some part of the risk. It's just the way we have limited capital and capacity that will be devoted to these risks from the private sector. Whether that's in terrorism, you can look at the TRIA program in the US or the Pool Re in the UK. There are a variety of different examples. But there will always be a role for us to partner with government, and that is so important for us to realize we can't do it alone, and certainly government ought not to do it alone. And so the public-private partnerships is such an important aspect. And I'll also refer you to Geneva Association. I see Dennis here on the front row. They've done a wonderful paper talking about what are the positive and good characteristics of a public-private partnership, and what are some that could really damage our system.
Thank you so much. Eddy, I want to ask you about modeling risk and how you're advising clients. So I have a very long question here. Loss models were historically built on the assumption that history is a reasonable guide to the future. When we're talking specifically about CAT models, climate change has already challenged that idea. And we need to add geopolitical volatility, supply chain fragmentation, potentially with risks with thin or no historical data. Do you think there are blind spots there in the modeling capabilities, and how are you advising your clients around that if you don't have a confident answer about where the picture is going?
Yeah, thank you, Kathryn. That's a great question. I'm an actuary, so I will probably not be too different from what Steven said. First of all, the actuaries like data. So the first important step is about data. But we have to understand if the data from the past is a good representation of today's risk and certainly of future risk. And I believe that's certainly a challenge for the actuaries. It's not taking the data as, yes, it's there, let's use it. but understand what is the data from the past, what was it covering, and is it covering the same level of risk than what we have today. So adjusting the data from the past is certainly one of the first steps before we go to the modeling. Then when we move to the modeling, I would say that we don't have black or white. We have good models we have models on blind spots. It's certainly the level of maturity of the model which is more important. I would say that today, on some peak risk for natural catastrophes, the models are quite mature, but nevertheless, the risk is changing very quickly. The volatility in the climate change in the different regions of the world is quite different, and those models have to be challenged on a daily basis to make sure that they are representative from the risk of today and the risk of tomorrow. That's the first step. Every time we have a shock, we have new models appearing, which is good, because that's helping in modeling the new risk, but the level of maturity is not always there. I would say cyber AI models are coming, some are more mature than others, but it's changing so quickly that we always have to challenge those models and making sure that they are more or less representative of the risk of today. We see also that some blind spots are still existing. Business interruption is certainly a specific area. Business interruption is triggered from different type of risk, and the modeling of business interruption, we have seen that during the COVID. Business interruption was a sort of surprise for the industry, and we still have some blind spots in that area. To finish on the comments on modeling, it's certainly also the interconnectedness, which is important, because we have models which are good for a specific risk, but the models are more or less in silos, not necessarily looking to the interconnectedness between the different risks. So looking to the correlation and the interconnectedness from the past is one, but again, how can it be transferred to the risk of today? And the fact that, as I said in my first question, that the depth and the volatility of the interconnectedness is changing very quickly. So I would say models are there are some blind spots, they are developing very well, but we have to be always very cautious on how to understand the results of the model and making sure we apply that with the right understanding for the right decisions that we'll be making from those models.
Okay. Stephen, back with you. This is something that I'm often thinking about in my work covering financial services, this sort of spectrum that we're seeing between stability and caution and growth and risk-taking. For you, I mean, there's probably a bigger tension between being cautious and continuing to grow in the current environment that we're seeing now. Do you have a recommendation on how the sector should deal with that spectrum or that tension? I mean, being relevant for society, but also being prudent?
Yeah, I guess to be relevant for society, I guess on the life and health side, we have contracts that are decades long. You know, people are paying premiums and committing us to be there in 50, 60, 70 years' time to pay them. So to be relevant, we need to make sure that we essentially, you know, it's growing cautiously. It's good risk management. So I think clearly, like in the short term, if you're too cautious, you know, there's short-term impacts on expenses and things. But it's definitely the concern is the faster growth is where you'd be more concerned. So I think kind of good disciplined risk management are kind of it's maybe more a P&C underwriting through the cycle, kind of maintaining like a disciplined growth strategy. Is always kind of more desirable in terms of remaining relevant. And they say we want to be there for the long term. Mm-hmm. So there's always kind of, I'd say we're always putting more on the prudent side and the careful growth there.
And I'm actually going to open up this one to any of you who want to respond. When we're thinking about the regulatory side, are there regulatory challenges, policy changes we could see that might help address what we're talking about, this challenges, you know, geopolitics, climate, cyber, supply chain, hurricanes, hacks? What do we need to see here? Who wants to go first?
I'll have a go. And also, I would just comment, you very sensibly placed me between two actuaries, which is a great ratio of actuaries to underwriters. So I think, I guess, one comment I would make in respect of climate, I think we've seen, and John will know this firsthand, the impact that legislative and regulatory change can make to insurability. So thinking about Florida, for example, which is a core part of the Lloyd's market, we write about 50% of our premium in the US, and a lot of that is catastrophe business. There was a period of time where Florida was approaching uninsurability. An element of that was climate change, so more stronger hurricanes threatening landfall, not necessarily making landfall. But a big chunk of that was the legislative environment that effectively allowed claims costs to spiral out of control to the point where insurance had become dollar swapping, which is not the model of insurance. Now, there was some good work done in Florida to really rein that back around assignment of benefits and various other things that fundamentally changed the insurability of that state, which I think is incredibly important. The insurance and reinsurance market wants to write that business, but we're not charities. We still have to be able to make return on capital. And if you get to the point where effectively every single claim is 5 times more expensive than you were pricing it to be, you will withdraw. So I think there is definitely a role for government and regulators there.
Who else wants to come in?
I'll chime in there because I don't think we can talk enough about this Florida change. So if you think about this litigation abuse, I'll just give you 2 numbers. Florida had 9% of the U.S. property claims. They had 79% pre-reform of property claims litigation. It was a litigation abuse problem. And we were fortunate enough, in November, ABIR hosted Governor DeSantis from Florida. He came, first Florida sitting governor to come to Bermuda to talk about the reinsurance market and these reforms because they will make a dramatic difference. Here's the takeaway. The takeaway is government leaders, whether they be governors or policymakers, can make a difference for our market. And we need to be working with them to help identify what are the cost drivers, where are the pain points, and how can we help consumers ultimately, which will help our market?
If I may add one point, I believe the forward-looking and understanding the need to be more resilient is important. So when we speak about climate, we often look to the future climate trajectory from the exposure perspective. But we know today that we will have to adapt. So the adaptation measures will be critical, and that's also something we have to better integrate in the approach, that when we are looking to the future of the climate, we are not only looking to the more negative part, which is the change in the exposure, in the hazard, but that we are also taking more into consideration the impact of the adaptation measures. And that's probably looking to Florida, where we need some support sometimes from the supervisors and from the different stakeholders, that we are not only taking the more conservative view of the change of the risk, but that we are also considering that adaptation could improve the risk in the future, could improve insurability, and we have to consider that to a larger extent into the approach.
The other actuary in the room, you want to come?
Yeah.
Okay, you're probably not the only 2 actuaries in the room, to be fair.
So I'd probably just add it to your question. I guess as a reinsurer, I guess the reinsurance model kind of works on that global diversification, the ability to kind of pool risk, from multiple places, and overall lower the cost of capital than could be achieved if all the risks were just maintained in the local markets. So I think in terms of requested policy measures, I think kind of whilst it's understandable that there's always a domestic reason kind of at the local level to put in maybe restrictions on cross-border activity, kind of localization of assets. I think overall that does make the system less resilient. So I think the ability to be able to kind of reinsure on a global basis, to use that pooling across kind of uncorrelated risks across the globe is very important. So whilst kind of it's understandable at a local level why they might want to kind of put in place kind of restrictions, I would say at the macro level, it makes the system less resilient by putting in those
John, back to you. International regulation, obviously very top of mind for the Bermudian insurers, reinsurers. Over the last decade, the IAIS has done a lot in terms of supervisory cooperation, collaboration. Where do you think that you see the main areas of value in enhanced collaboration going forward?
So supervision and regulation is probably the most important calling card for the Bermuda market. So if you think we're a small island in the Atlantic, our business is not written in Bermuda, it's written globally. And so what the host supervisor thinks of Bermuda is by far the most important thing. And so it's no accident that ABIR has the former state insurance commissioner as the CEO of the group. But more importantly, it's important for us to work with organized supervisors, whether it be the NAIC and in the U.S. With Beth Dwyer, the president-elect here, is one of your next speakers, or EOPA, or the IAIS. So I've been saying all of this year, and it will be a theme of mine, particularly on the reinsurance side, not all reinsurance is created equal. And if you think about, we're still, I think, the only industry, we sell a product that we have no idea, we have a guess, but we have no idea what that product's going to cost until later down the road. And so the safety and soundness and confidence of the regulatory regime on the capital side, claims paying capital to be ready. We've had some conversations about private credit, but we got to make sure that mix of capital is ready to respond. So Monday's the first day of Atlantic hurricane season. You bet your bottom dollar that Bermuda reinsurers have to be ready with liquid capital for the first hurricane that hits the Atlantic season. So I do think that probably the most important aspect for supervisors in the short term and medium term will be to make sure they're nailing down what we call mutual recognition. And whether that be Solvency II equivalence decisions, or in the U.S., qualified and reciprocal jurisdictions, because there has to be this confidence between cross-border transactions. We are an international business, and you will meet people, we've all met people that are new to our industry, and their first reaction is, how do we keep all of our business? How do we be protectionist? And how do we keep it all in our jurisdiction? Because they don't yet understand our business, that we have to have international aspect. You want to export risk. You don't want to contain risk within your jurisdiction. So I think mutual recognition is the short answer.
Eddy, I want to ask you about protection gaps. There's been a lot of work around this topic in the last couple of years. We're seeing more understanding of their scope, their magnitude. Which area of analytics do you see there being the most development in the coming years? And what impact could that have on protection gaps?
Yeah, thank you, Kathryn. First, I would say that protection gap is always mentioned in the area of the natural catastrophes, in the area of AI, in the area of terror, but it's not limited to those areas. We have protection gaps in many places. Pension is certainly an area where the pension gap is increasing, and that's only one of the examples. One important aspect, there is a large hope on the data. With the new technologies, we hope we can have better access to data, we can manage data in a better way to support what is the protection gap today, understanding why there is a gap, and trying to use the data to better simulate and help the public counterparties to understand and to try to understand the economics of a public-private partnership in that respect. But we have to be cautious that with the new technology, and I see that sometimes when I'm teaching to the actuarial students, that we not become blind on data and say, we have the data, we put it in a model, and then we have something. We have to keep control of the data and making sure that we understand data very well. And if we do that, we can really support the developments and the decrease in the protection gap. We have also to understand the new risk and making sure that we can have some modeling. Again, models are coming from data, are supported by data, but we have to be also a bit more forward-looking. Understand that the risk is changing and make some stress tests make some scenarios which will complete what we have in the data, what we have in the models of today. And again, we are not looking to do science fictions to try to model in the next 30 years, but try to see what is the sensitivity of the risk and how we can help. And certainly something important as the last comment is understand that in a model it's not only the average trajectory. Speaking about climate change, this is important. We see today that the climate is changing very quickly. We are perhaps not on the average trajectory anymore, on the +2, +3, or +4 degrees, but we could be more on a trajectory which is more difficult to manage. And we have to understand that there is volatility. Volatility is increasing, and we have to take that into account. So that's certainly an important aspect. And always be ready. New risk is coming, and we have to react very quickly.
Be prepared. Patrick. Speaking of preparedness, this is what I want to give you the last word on before we take some questions from the audience. We've seen in the last years various events that the scientific community has been aware that it's coming, that hasn't necessarily percolated to sort of the wider world, things like the risk of pandemics, the risk of natural catastrophes. What types of risks do you think the insurance market, society, take it how you like, are underestimating? And where should our efforts on preparedness focus specifically as priorities?
Yeah, it's a good question. I'll try and answer it relatively quickly to give the audience time to ask their questions as well. I think AI has already been mentioned on this panel, and I'm sure you can't go to an insurance conference or any conference without AI being mentioned at the moment. I think there are some challenges around understanding the impacts that AI will have on society, frankly. If we think about the insurance industry for a brief moment, there are 2 or 3 aspects of it that we feel we really need to understand pretty quickly. One is the impact on people, so the workforce. How will we manage through job roles changing, AI increasingly being used, but with a specific lens on not losing the skills that people have built up over time. If you entirely outsource to AI in a relatively short period of time, no one actually understands how these models work anymore, and you can't adapt them, adjust them if they begin to go wrong. So I think there's a sort of people element to this. I think there's also an element, and this is very, very small scale at the moment, but will increase relatively rapidly, is the use of AI by insurance companies to do better modeling, to interrogate large data sources. This is nascent at the moment, but increasing rapidly, and we need to understand the huge opportunities and improvements that will bring to pricing, understanding how the risk environment is changing, but also the potential downsides that exist there. So if we entirely outsource pricing or accumulation to models, and you have model drift over time that no one understands, you end up with a relatively systemic problem. That's something that simply does not exist now because AI is not embedded in the way that it will be, but we need to be front foot and get ahead of that. And then finally, and probably closest to my heart, is the need to understand how AI being used by the businesses that we insure will change the risk profile of those businesses. Does it make them better risks? Does it make them worse risks? And in what ways? And how do you adjust the underwriting around that? And it will be multifaceted, it will be complex, but the one thing we can say for certain is AI is going to increasingly embed itself in everyday life, business life, the insurance industry, and if we don't get our arms around it now, we will find that it's out of control relatively quickly.
Thank you so much. Q&A time. So I think you all have access to the QR code if you want to submit an anonymous question. I'm hoping that since the questions are anonymous, people will be more candid and we'll get all the juicy stuff. I'm already seeing some good ones coming in here. Okay. Is the recent increase in protectionism, anyone can take this, for example, Trump, hurting the global reinsurance model? Nice question. Who wants to take this one?
I'm the American, so I'll go first. So, and it's not related to the president at all. It's related just to the concept of protectionism. Our industry works works better with less protectionism because we're an international market. And protectionism, wherever it is, whether it's in the United States or Europe or Asia or any other market, is very negative to our business. So we need to call it out, but call it out in terms of data and call it out in terms of the impact on the ultimate consumer and the jurisdiction. And you could use countless examples. You could use the tariff examples on increasing the loss cost or claims cost for rebuilding communities. You could just go down the road of identifying them, but it's our job to identify when it happens, and it's our job to be uniform and have unity in making sure we point it out.
Anyone else want to share some thoughts?
I will not say if it's bad or not, so that's, but I would say, what are some of the consequences? We discuss about data. It's clear that protectionism is limiting sometimes the access to data, and we have to understand that. So it will become more difficult to have access to the data, to develop the models, and to understand the risk in a good way. And sometimes in the way we are transferring risk in the reinsurance market, but we are not always able to transfer the data in an open way. So that's sometimes limiting the quality of the risk transfer and the access to the global market. So it's more about the limitations that it's creating, right or wrong. That's another discussion. But there are certainly some consequences, and it's also adding to the volatility, no doubt about that.
No last minute thoughts?
I mean, I would only add to John's point. I think the need to understand the support that the global reinsurance industry provides to any individual territory is absolutely critical. You know, the US insurance market cannot function without the global reinsurance market. That's, you know, particularly the case in Florida, but it's the case across the US. You know, we see business flowing into the excess and surplus lines market in response to changing conditions. Fundamentally, if that excess and surplus lines market didn't exist, or the global reinsurance market didn't exist, the protection gap that we've spoken about today would be significantly greater.
Any thoughts?
It's the same comments earlier, and I made a comment earlier, like that global diversification is so important to the business model, that this protection, if you start putting in more and more kind of local requirements and restrictions and collateralization, it does affect the business model. But at the moment, the balance is okay, but there's the trend or the noise is for more kind of protectionism. So we're certainly cognizant of that and trying to push back on that.
Okay, you're all agreeing far too much, so maybe you'll disagree on this one. If you had a magic wand and could simplify one piece of insurance regulation to reduce the regulatory burdens on the industry, what would it be?
So I'll go first, because the answer to this is easy for me, because it's not really an area of the business that Lloyd's is hugely involved in. But even for an entity that is not significantly involved in consumer business, some of the regulation about consumer protection is just adds layers and layers of complexity and cost around writing those types of business lines. It's one of the primary reasons why we don't do a lot of it, actually. So I think some deep thought on getting the balance right between consumer protection and overregulation would be really helpful.
I'll explain it in one word: proportionality. And the supervisors are getting very sophisticated on doing risk-based supervision, but that we can do more and help them do more of making sure that all of the supervisory tools they're using are proportionate to the risk that's out there. And you know, we've had a lot of discussion, for instance, on anti-money laundering. It's nearly impossible, I would say impossible, to launder money through a property and casualty hurricane loss. But we need to really focus on where's the proportionality of applying the principles of supervision where the risk is.
That sounded like more than one word to me.
Sorry.
Who else wants to cover the simplification wish list?
Mine's probably maybe it's not a piece of regulation, but I'd say maybe more around harmonization and gold plating. So I think even in Europe, it's a common regulatory standard, but I think every regulator has their own kind of nuances and topics and local requirements as well. So I think that greater harmonization in Europe would still kind of look to see if regulators could work together and have a consistent approach, because we do see across Europe like different approaches for different risks, different type of business. There's still different interpretations, even though it's a common framework. I think kind of that continued push for harmonization would be.
What I would say, proportionality, materiality are certainly key aspects. But I would say with the speed of the changes is also having the regulation adjusting to that. When we see that when changing something in the regulation takes multiple years, while the risks are changing so quickly, we also need regulation to react more quickly. I was mentioning adaptation measures, or can we better recognize adaptation measures in the capital requirements? All those things have to be a little bit quicker than it is today.
Okay. I think I'm going to wrap it up there because the people want their coffee. But before we thank our panelists for their interventions in this session, let me just say, next we're going to have a coffee break. There will be refreshments in the foyer and library, and we'll see you back here at 11:30. Now, thank you to all our panelists. Thank you.